Hello, everybody. I am excited to be here with y'all and talk a little bit about the home purchase process. I want to start off with a little story on how I'm going to show you guys all the practical stuff on how to qualify your credit, the process, and everything else. But first and foremost, it's believing God for it. Jason and I bought a home last July, and I've been a loan officer for almost 20 years or for 20 years. And at the time that we did the application, I didn't think we were going to qualify. We found a home. It was a prolonged process. And I didn't think we were going to qualify. And so Jason said, you really have to pray and you have to believe and you have to get on your knees and you have to really believe that this can happen for you. And so there's a lot of different things that had to happen, and I'm like, it's not going to happen for us just because I'm not just a loan officer, I'm a really good one at that. And there was a lot of stuff. It was just, I didn't think it was going to be the right time. But at the end of the day, it's God's timing. We went through the process. And I think the biggest lesson for me was believing that it could happen for us, even though we had all these different things that we had to work through, and that He was going to make it happen for us. We did the practical. We did the credit, and we did the different steps that we had to take to be able to qualify. But I think what really got us into the home was believing and praying. Questions afterwards. New American Funding is, well, we can watch the video.
Of your home's equity. You may be asking yourself, what's the difference between New American Funding and a big bank? There are quite a few advantages to choosing New American Funding over a big bank. At New American Funding, you can have a complimentary So you're ready to purchase a new home.
If we can't bring it up, that's okay. So New American Funding is based out of Orange County. We're a mortgage banker, and a lot of people don't know what the difference is. We're just not a depository institution. All we do is mortgages. All we do is residential mortgages. And so we sell directly to the agencies, and for that reason, I do feel that we have a lot more flexibility compared to one of the bigger banks like the one that he works for, or just kidding. Or, some of the credit unions, because they're restricted. We really focus on helping minority home ownership, on inclusion, and so we underwrite based off of that. It's easier to qualify. Our credit score restrictions are a little bit easier, and so that's really what the main difference between New American Funding and a credit union or a bank. You also have somebody that's here that's walking you through the whole process. Our whole team is here. Our processor, our underwriter, everybody is all working towards the same goal, where when you're working with the bigger bank, and all of us have things that we're good at, and I'm not taking anything away from the bigger banks, but they also outsource some of their underwriting overseas, and so for that reason, it's very disconnected, the process. So if you have any credit challenges, or if you think that anything could be outside the box, it's not as if you can get a hold of somebody right away. You call an 800 number, and then they transfer you, and so it's just a lot easier to get financing through somebody that is working for you. We could do the next slide. So the next slide just talks a little bit about why you should buy instead of renting. And on an average, the appreciation when you purchase a home is anywhere between 4 to 6%. So when you do the long-term math after 30 years, you're almost tripling your equity. And that varies depending on what area you're in. It could depreciate or it could appreciate at different rates. But long-term, that is really one of the vehicles that's mostly used for retirement. And you also don't want to put all your eggs in one basket and just bank on retiring off of your equity, but it's one of the fastest vehicles that can get you some generational wealth in the long run. As far as the interest rates right now, they're crazy low, guys. I mean, they're in the twos. I had never seen anything under 2, and I locked in a 15-year refinance at 1.99. That is free money, and especially when you take into consideration the tax deductions that you get at the end of the year, it's really, really right now that time to buy. Your taxes, that you pay on your mortgage, those are also tax deductible depending on the income bracket that you're in and all these different factors, but you're in essence borrowing free money, and when you're renting, you're just paying somebody else's mortgage. As far as getting pre-approved, we've worked with families for 3 years. I've worked with families for 5 years getting them into a home. Everybody's at a different stage. Some people have a lot of credit challenges, and I'm not a credit repair person, but I've been doing this long enough to where I can give you guys advice on what you guys need to do from start to finish to be able to get to where you need to be at. A lot of people are self-employed. That's another deterrent, that they write off all of their income, and so they don't qualify. But right now is a good time of year to come and visit somebody that does mortgages, so that way they can give you some sort of advice on I can't tell you like, hey, this is exactly how much you need to file, but I can tell you based off of your debt, if you were to make this amount of money, this is how much you can qualify for. And at the end of the day, I really think that it's really important for you to not walk blindly. You're walking through the whole process with the professional that has your best interest in mind. So when we're looking at qualifying, after we take a look at your credit, we look at your income and your debt to income ratio. And what that means is how much money do you make on a monthly basis. We divide it by how much debt you have, and then we include the proposed housing payment. And that number has to be a certain percentage in order for us to be able to qualify. And so that's where I'm saying that when you come and you visit with us, a lot of times, a lot of people don't qualify. Demographically speaking here, everybody charges up their credit card. They have all kinds of vehicles on their loans, on their credit. So it's really important just to go through that process, see how much you can qualify for. After figuring out how your credit is and how much money you can afford to borrow with your income, the next step is determining how much your down payment is going to be. And there's a lot of programs, guys. There's down payment assistance. There's all kinds of stuff. So really what I like for you guys to do, if you guys are interested or will be interested in the next couple of years, is to do the application. Let's figure out what the best program for you, because there are pros and cons on all of them, and it's very different, like what would be the best thing for you versus what the best thing for you would be, because we take into consideration how long are you going to be in the property. Do you plan on occupying it as your primary residence? All these different things, so that way we're able to assess and give you the best advice. I think credit is going to be the biggest topic as far as like anytime that we do a first-time home buyer seminar, there's a lot of questions revolving credit. That could be a whole class in itself. So I'm going to touch just on the basics, and then we could in the future maybe do a credit class, because that could be a whole hour. There's 3 credit bureaus. There's TransUnion, there's Equifax, and then there's Experian. And so what we do is we take the middle score into consideration for qualifying purposes. A lot of people think as far as like what goes into the credit, obviously is your payment history. We want to make sure, and what we're looking at, we're really scrutinizing the last 12 months. So if you've had credit blemishes in the past 24 months, it's all about making a story. We have to just figure out what's the likeliness if I extend a loan to you that you're gonna pay me back. If you have a whole bunch of lates in the last 12 months, your likeliness of me paying me on time is not gonna be there. And so that's really what we're looking for. We're able to take a look at the credit and see if you have revolving accounts. Revolving accounts are credit cards. And so we normally like to see no more than 20% of however much your high limit is. So if you have a credit card and they've given you $100, we don't want to have any more than $20 on there, because once you overcharge it more than that 20%, it starts affecting your credit negatively. So that's really one of the things that I look at. Is I go through the credit report, we see where your balances are at, and our goal is to get you to that 20%. As far as installment, those are like vehicle loans or anything like another mortgage or an installment. Those really, I mean, we want to make sure that you're paying them on time, but they don't really weigh a lot on your credit. Unless you're not paying them on time, then they weigh a lot, but otherwise they don't. Really the biggest thing, if you've had situations, because life happens, sometimes you lose a job, or if you're self-employed, you know, COVID might have affected your income, and so hence your credit has been affected. The best, I guess, is to wait it out. And that's where, okay, well, we know that you've had these circumstances that made you be late on your credit. So now how long does it take to repair? How long is it gonna take? Usually it's at 12 to 24 months. Where are we? Making sure that I'm talking on the right slide. We can go to the next one. So as far as you go through the application process and you figure out that you're able to qualify, how much money are you gonna need down? So different programs require different down payments. And this slide is just about the closing costs. The closing cost is gonna be anywhere between 2 to 5% of the purchase price, depending on what type of financing you're getting. So if your sales price, and just for easy math purposes, if it's $100,000, then your closing cost is going to be right around $5,000, and then you're going to have to put however much money down as required by the loan program, and we'll go into that a little bit later. The closing costs cover the lender fees, the title company fees, the appraisal fees, pretty much all of the costs that you're going to encounter throughout the process. So that way you guys know how much money do I need to have saved by the time that I'm going to go under contract. A lot of the closing costs could be paid for by the seller. It just depends on what kind of market you're in. So here in El Paso, for the last forever since I've been doing this, the seller pays most of your closing cost. Right now, since last year, we've had a shortage of inventory, and so most contracts are coming in with the buyer paying the closing cost, but it's not to say that it's gonna stay that way, and every situation and every transaction is different, so it's just really important to not only align yourself with a reputable lender, preferably New American Funding, but also with a real estate agent that you've interviewed and that you know that they have your best interest in mind. One of the questions that I get a lot is who pays the real estate commission? And that's something that has been predetermined and negotiated to be paid for by the seller. So a lot of times people will go and want to purchase a home, and they'll go directly to whoever has that listing. And that real estate agent has a contract with the seller, so their fiduciary responsibility is really to the seller, and they can advise and write the contract to where they're helping you out, but they're not working for you. So it's better for you to hire your own real estate agent so that way they can help you negotiate through the process. Okay? Your mortgage payment is, a lot of times you'll hear mortgage lingo will say your PITI, that's your principal, interest, taxes, and insurance. So you want to make sure when you guys are going online and calculating, there's all kinds of mortgage calculators, you want to make sure that it has the accurate taxes in El Paso. Did you guys know that El Paso is one of the highest tax counties in the whole United States? Crazy. And so what you calculate online is completely different if you don't plug in the right taxes. Taxes for Texas, for El Paso, they're right around 3.2% of whatever your sales price is. Taxes for New Mexico are right around 1.2, right? 1.25 or so. So it can make a big difference on how much your payment is and how much you qualify for. So a lot of times, being that we're on the border, people will purchase the New Mexico because you can qualify for more because of the payment. But then there's state taxes and all kinds of other things that you have to take into consideration. So the first time home buyer programs, those are all driven by you have to, how do I say this? There's income requirements, and so we go by family size and how much household income there is, and even if your child is over 18 and living with you, we have to take their income into consideration. So there's all these different things. So the best way to figure out what programs you qualify for is talking to a loan officer. So now we'll go into the different types of loan programs that there are. The one that's really prevalent here in El Paso, and I think just pretty much in our area, is FHA. That's one of the easiest loan programs to qualify, not only because the credit score restriction is easier, it's 580, so all you need is a 580 to qualify, but also because it allows the debt to income ratio to go all the way up to 56%. And so that's really high. So you can take whatever your monthly income is divided by 56%, and that's how much threshold you have to be able to qualify. VA is also one that's really common here because we have the military base, and that's zero down payment. So there's no down payment. The interest rate on any sort of government financing, which is FHA or VA, it's really, really low right now. We're right around, and I can't quote a rate because there's all these things that go into consideration, but just as an example, we're right around 2.25. The reason is because the government is backing the loan, that if for whatever reason you guys were to not pay us back, the lender gets a percentage of however much we loan you back, and so it's a little bit less of a risk for the lender, and that's why we're able to offer you more flexible terms along with a better interest rate. There's pros and cons to both. Conventional, the interest rate is a little bit higher, so everybody's going like, why would I want to go conventional if the interest rate is higher? It's because you don't have the mortgage insurance for the life of the loan. So once you have 20% equity, then the mortgage insurance goes away. So these are all the questions that I'm asking when we're going through the application is how long do you plan on living in the property? And how much money do you want to put down? And was interest rate, and then we compare the payment, and then we determine what's going to be best for you. VA recently did away with their maximum or loan amount, so there's no restriction. So you can, if you have VA eligibility, you can go up to $2 million if you wanted to, and VA will guarantee the loan. And that's one of the big changes that just happened recently, last year. FHA, the loan amount is $333. That just recently changed too. And conventional, it's 500 and I didn't update that. It's 530 10. Thanks, Edgar. So FHA, 3.5% down. VA, 0 down. Conventional is 5% down. There are programs with 3% down for conventional, but there's all kinds of restrictions, so we'll go over those on an individual basis. So like I said, talking to somebody that is in the industry and going over all of the pros and cons, because what's best for one person might be different for the other. Another thing is when you guys are shopping, a lot of times people will come to me and they had already gone online and they went to Lending Tree or whatever, whatever company. And they come and they say, oh, well, they quoted me a really good interest rate, and the interest rate might be better than what I'm offering. But it's all about comparing apples to apples, because what's the total cost? A lot of times there's all kinds of like hidden fees, origination, and discount points. And so what I always say is, let me help you compare. Even if I'm not your best option, let me make sure that you're making an educated decision that really, because it's hard for you as a consumer. If you don't do this for a living, comparing the worksheets, it's difficult. And so you want to make sure that if you're shopping and you're looking online, that you're asking all of those questions. Knowing when to lock your loan after you're under contract is also really important, and that's something that you have to ask. Is your interest rate fixed? Is it gonna fluctuate? There's all kinds of different loan programs. Is it interest only? It's not as common as it used to be before, but it's still questions that you want to ask. I kind of joke around and I tell Jason that that's one of the reasons why I married him, so that way I can have free lock advice. It's really important just to know, just because interest rates change every day, and sometimes they change a couple of times a day. And a difference on your mortgage of a quarter can mean a savings of $30,000 to $40,000 in the long run. So it's really important. And I'm not much of a gambler, so a lot of times when people come in, I say, let's just lock. It's better for us not to ride the market, especially with everything that's going on with the economy right now. But for those that are really wanting to get the best interest rate, sometimes they'll float and they lock right at the right time. I want to also talk a little bit about the difference of getting pre-approved versus pre-qualified. A lot of lenders will issue a pre-qualification letter based off of information that you put in the application. So what happens now? You have a pre-qualification, you find your dream home, you put a contract, and then you go through the process, and then you figure out that you didn't qualify. Well, who wants to be heartbroken like that? It's really important that you know that you got pre-approved and not just pre-qualified. And the difference is that we're verifying the information that you put on the application. And so last year, a lot of people were impacted by COVID. Their income was reduced. And so when they did that loan application, they put 40 hours a week at $20 an hour. And then we say, okay, great, that's what we can qualify you on. But then you look at your year to date, and it's a lot less than what they put on the application. Well, then you start asking questions, what happened? Well, they were off for 2 weeks for COVID and another 3 weeks because they got laid off. And so we have to use worst case scenario. And so it's important for you to know that you're pre-approved and not just pre-qualified, because they're going through all those different things, because it's heartbreaking. There's so many people that issue that pre-qualification loosely, and they allow these families to go through that process, and then they lose their earnest money, they lose their appraisal money, and it's heartbreaking. One number that's really cool as far as New American Funding, year over year, we have been able to save 23% of the transactions that we've done had been denied elsewhere. I think that's so cool. I just, especially when you humanize the process and you think about, you go under contract and then you give the earnest money, and then you get a call and you say, they tell you that you don't qualify anymore. And then they come to us and we're able to rescue the deal. Yeah, that's really why I love doing what I love. I love doing this. We do about 1,200 transactions, so in El Paso. So when you divide that up in 23%, that's a lot of families. I think that's so cool. As far as paperwork that we're going to ask you for, the normal is 1 month pay stubs, 2 months bank statements, 2-year tax returns. On the little handouts, it has the list of the basics. If you have a unique situation and if you're self-employed and if you, all kinds of different things, then we'll do a personal to-do list. How long does it take for us to process the loan? Well, normally about 30 days. Right now, we're a little bit delayed, not necessarily because of the lender, but because we rely on a lot of third parties. So we have to wait for the appraiser, we have to wait for the inspection, we have to wait for a lot of different people. And so right now, we're quoting about 45 days. Can I close it sooner? Can we close it sooner? Yeah, for sure. It just depends on how fast are you guys gonna get us the documents and how fast are we gonna be able to get all of the other people to fall in line to be able to close you. Let's see. We can go to the slide where it says who else is involved. I think the first step is getting pre-qualified. And then after that is interviewing your real estate agent. And then after that, the lender orders the appraisal, so you don't have a choice on who it goes through. I don't even have a choice on who it goes through. I go through an appraisal management company, and then I don't know who the appraiser is until we receive the report back. The inspector is the one that goes out there and they make sure that everything, the integrity of the house is there, the electrical, the roof, everything. And so that's really important. It's not required by the lender, but it's a small investment for you to know what kind of house you're getting into. And even when it's new construction, because right now, a lot of the new, labor is short, they're cutting corners, not all of the builders, especially not the builders that we work with, but it's just important for you to know what you're investing in. It's barely 7:13. I didn't want to keep you guys here all night. So if you guys have questions on how to, not yet, Bobby, and if you guys want to get an assessment on your credit, I do have the ability to pull a soft pull. One of the reasons why I invited Edgar is because I want him to help me give you guys the credit assessment, so I can give you guys on the booklet. There's a little QR code, and you guys can do the application, and it's gonna ask you for about 10 minutes worth of questions. Then we'll be able to pull a soft pull. It's gonna ask you guys who you guys were referred by. If you guys can put that you were referred by church or Joy Center, so that way I know, hey, these people were not maybe quite ready to put you through the whole mortgage process, but that we want to run your credit and give you advice on what do you need to do, what do you need to pay off, what kind of help you need from start to finish. It's, I think, one of the biggest reasons why people don't apply is because they know that they don't qualify, and that is the reason why they aren't in a home that's their own. And sometimes they think it's unattainable or that it's gonna take a lot more, when that might not be the case. I had a situation even last Friday, and this one was a refi consultation, and he's self-employed. He thought that he wrote off a lot of income, and really he did, but it was all depreciation, so it was stuff that I was able to add. And the rule of thumb with a refinance is for you to be able to save at least a point on your interest rate, and that we're not setting you back from, if you've been in the house for 7 years, that we're not resetting it to 30. So at that point, we would look to see what your payment would be on a 15 or a 20-year mortgage. and it could be a lot of money in the long run, so we want to make sure that we're going through that whole process. But like I was saying, one of the reasons why people don't apply is because they think that they won't qualify. And had I listened to that instead of Jason saying, we need to pray and we need to get on our knees and really believe for it, we would still be renting. And I'm a loan officer, so I think that that's one of the ways that I can help you guys get into a home is by giving you guys that assessment. So the last slide is a plug for, this is the first time in my career that I'm offering a mortgage mentorship. If you guys are maybe interested in knowing what the mortgage industry does, is there a career opportunity for you? I'm gonna do 1 hour a week on Thursdays for the month of February, where I'm just gonna really dive in and talk about what opportunities there are. They're not all 100% commission. How do I get into the mortgage industry? So if you guys are interested in doing a mentorship or just learning a little bit more, it's a very good career with a lot of opportunity. Nobody plans for this. It's not like you're little and you're like, I want to be a mortgage person. Says nobody ever. And so I was waitressing and found an ad on a Sunday paper. I applied and it's changed my life, not only because it's a good career to be in, but because I'm able to change people's lives and make friendships. And some of the people that I've extended financing through, I'm friends with 10, 15 years later. So if you guys want to learn a little bit more about it, it's an hour a week, Thursdays, and shoot me an email. I'll send you guys all the information, or it's on my Facebook. And I'll open up the floor for questions. Bobby? They're gonna wait for your mic.
I have two questions. Okay. The first one is, if we go through the pre-approval application, does it affect our credit at all or come with any commitment? Like if we just wanted to go through the pre-approval process?
So the first time that they pull your credit for a mortgage inquiry, it affects your credit anywhere between 3 to 5 points. If you were to apply with multiple people, the system does recognize that it's for a mortgage and it's only gonna affect you as if it's one inquiry, as long as it's within 60 days. The pre-approval doesn't really expire. Credit is good for 90 days, but after that, all we have to do is refresh credit to make sure that you didn't go buy a car or get any additional liabilities, and that you're still working, that all of the information on the application when you did the pre-approval is still the same.
Okay. And then my second question is...
And there's no commitment. So
okay.
If you come and there's no commitment. It's always good to know all your options.
Okay. With the market being, like you said, short inventory, do you recommend building instead of buying a pre-existing home, or you're kind of just,
I think everybody's different and everybody's needs are different. I don't have a preference between new build and resale. It just depends on what neighborhood do you want to be in, your price point, all kinds of different things, and if you're not ready right now. So for instance, if you're not ready, then building might be a good choice because that puts you 8 months to 10 months out. So it really just depends on your individual needs.
Thank you.
Hello. Do you consider future income as qualifying for a loan? And if you do rentals and things like that, what percentage do you take in for income?
What kind of, say that again, the last part?
If you have a rental property, what percentage would you consider in our income or to go into the income?
So as far as rental income, there's not a percentage. It's a calculation that we have to do. We do add back the depreciation, but it's a calculation that we have to do. So I wouldn't really be able to give you a percentage. It used to be 75% of the rental income, but now we have, depending on the type of loan, there's different calculations that determines what the income is on your Schedule E.
Okay, and then do you all use future income as far as?
It depends on what type of future income. So if somebody like is going to start a job in the next 2 months and they have an offer letter, as long as the offer letter doesn't have any contingencies, then we're able to utilize that income. But if it's future and not like tangible income, then it's really hard to say because every situation's different.
Thank you.
You can open me up. I'll take it. I'll do a question. Tanya, I have a question. So how many mortgages, right along the line where he's going, so how many mortgages can I get in my name
So
as an investor if I want to?
per like Fannie and Freddie guidelines, you can get up to 10 mortgages. A lender normally won't service more than 5 to 7, depending on the individual strength of the buyer. And the reasoning behind that is that we don't want to be responsible for, like, we extend 10 mortgages, something happens, and we have 10 mortgages invested into that one individual. But usually agency guidelines, it's 10.
Okay, and along with his question, so do y'all calculate that rental income as part of that as income, or do y'all put that in the calculation?
So we have to put it into that calculation. So it's not as easy as if you have a rental property and then you make $1,500 a month. We're not going to give you credit for the full 15. We're going to go through the Schedule E income or Schedule E on your tax return and do the calculation depending on which type of financing you're getting. Mm-hmm. And after that, that's like the net number is what we use.
Okay, and then along with that, do y'all do portfolio loans then?
I don't do portfolio loans, but if you have individual situations, I can give you an assessment and let you know if we're not able to do it, but there's a way to do it, I can direct you. Portfolio loans are usually like private investors, and the interest rates are a little bit higher, and we don't extend those type of loans. Another person that I didn't, going back to the presentation, how I was talking about the appraiser and the inspector and the loan officer and the real estate agent, the other person involved in the transaction is the insurance agent. And so a lot of times when you get the PITI, your principal, interest, taxes, and insurance, the insurance is for the property, and depending on what kind of deductibles and what kind of insurance you're getting for the home, then that'll determine how much it is on a monthly basis. We do recommend, so normally when somebody's going through the process, I do get a couple of quotes for them, and then I also ask them to get a quote from whoever you have your vehicles insured with, and then we go with the one that has the best deductibles and the best cost. Any other questions?
So I know you said that you've worked with people to get into a home for even up to 5 years. So outside of credit, that's obviously a big thing that has kept people outside of homes. So what would you say is the biggest hurdle to overcome with a first-time home buyer?
Debt. A lot of young people don't really realize what credit is until it's too late, and so they have a lot of debt. So paying down the debt within their means sometimes takes a year or 2 years. Restoring credit, income. Sometimes like a really young person will come in and they've only been at their job for a year, so we need to have at least a 2-year requirement. We are able to replace the 2-year requirement with if you were going to school to be a teacher, and so you've been in school for 4 years and then you've only been a teacher for 6 months. We are able to take the 2-year history or the school as part of your 2-year history, but the biggest deterrent is probably debt.
Thank you.
Any other questions?
I'll do one more. for loan-to-value ratios on a refinance. So in that same scenario, you have a few rentals. What is your, like 75%, 80%, or what do you guys do?
The debt to income ratio on a conventional is at 45.
And on a refinance?
It's still 45%. Your loan to value, if it's an investment property, you could only go up to 75% on a refi. And if it's homestead, it's up to 95.
This is actually, can you hear me? Okay. This is actually for our daughter, Erica. She's watching you online.
Hi.
She said, in what circumstances, if any, would you recommend purchasing points to buy down the interest rate?
So I usually don't ever recommend for you to pay down your interest rate because it's a very big investment compared to a very small savings. So as long as, if they were saving a substantial amount on the interest rate, then it might be worth it. But the market changes every day, and so today I might be quoting, let's say, a 2.5. And to buy it down to, so it's not like you're buying a whole point on your interest rate. It's not like you're gonna buy it down to a 1.5. It's gonna be like an 1/8 increment. And so on a $250,000 home, to buy down the interest rate by a quarter can cost you up to $2,500 to $3,000. Now, is that gonna really be worth it for you to invest that money out of pocket versus how much money you're saving on a monthly basis? So we go over all of that when they're ready to lock, like this is the interest rate that we have to offer. This is how much it would cost you to get a lower interest rate. And then we would divide the monthly savings versus your initial investment and see if it's worth it. And it's usually not.
Are you currently charging additional money down? For example, people say that the rates are so low now that lenders like yourself are charging additional points to protect themselves.
So it's all about the bank's appetite. So it depends on what type of loan, probably what you've been appetite for whatever type of financing that you're talking about. And so we did see a huge influx in refinances last year, and the lenders did start charging what we call LLPAs, and so it's not necessarily money up front, but it's a hit that the interest rate takes when it's a refi. And that was just because we didn't have, and when I say we, I don't mean New American Funding, I mean industry-wide. We didn't have enough boots on the ground to be able to cover all of the volume that was coming through because of the interest rates being so low. So they were like, hey, wait. And so they added additional fees to the interest rate. So when you were to like lock in for a purchase, then you would get a 2.5 versus if you were locking in for a refi, it was like 3%. So it was a little bit higher, but not any money outside your pocket. Does that make sense?
Yes. Well, I was told that they were charging additional because the rate was so low. So if I got it at 2.9, now the rate's at 1.99. In 6 months, they're afraid you're going to jump and leave them and go to another lender to get the 1.99. So it was protecting their money per se.
And I don't know what other lenders are doing, but as far as New American Funding, I've never heard of that.
What is your minimum credit score number in order to refi for a cash out?
So that's a little bit more of a case by case because there's really not any, like I can't say it's a 640 or a 680. What we have to do as loan officers, we take all your information, we run it through the system, and then the system tells us if you're approved. We really start seeing the approvals on cash out refis at 680. Anything less than the 680, it's really by case, and it runs it through the system. And what it's doing, it's assessing the risk of how much money do you have in your bank account, what's your debt to income ratio. It's looking at the overall situation, and then from there, it lets us know if you're approved or not.
And what's the minimum credit score for FHA and for those?
So the
that
minimum
need-
credit score for FHA is the 580. And one of the reasons why we put so many people into an FHA loan is because we are able to do a manual underwrite. So how I just talked about running it through the system. If the system doesn't give us an approval, but we're able to tell a story, then we're able to approve it. If we can write a letter of explanation for the derogatory credit, and then we could make the underwriter see that it was a one-off, like it happened because there was extenuating circumstances, and not something that is going to be residual, then we're able to do the loan. The minimum credit score for VA is also a 580, and the same there. We're able to do a manual underwrite if you have extenuating circumstances. You guys want to hear a funny story? So I used to, for like probably forever, I used to talk to my buyers, and I would say, if you have excruciating circumstances, and I didn't know the difference between excruciating and extenuating until like somebody said, Tanya, it's not excruciating, it's extenuating.
That's
Anyway,
very
that was
painful.
kind of funny. Very excruciating.
I have one more. Do you all outsource for your underwriting, or is it in-house?
So it's in-house, and I've been with New American Funding for 6 years, and there are national underwriters. The benefit to our queue is that we've hand-selected the ones that have the same heart like we do, the people that are wanting to get people. There's underwriting. A lot of them are just sitting behind a desk trying to figure out how to not make the loan work, and so we've been very blessed to work with the team of people that are looking to see how can we make it happen for our buyers. And that's really what I think the difference is that all of the team is aligned. Our processor comes to church here, and one of our main processors, our underwriter, is very much just involved in how can we make it happen for these people? How do we think outside the box? What can we do to get them into their home? And so we do service all of our loans, about 95%. So New American Funding ultimately has the say-so. You know, are we going to be able to? And it's a local, not local, it's a privately held company. I work for there's two owners, a husband and a wife, and they're very much involved in the company. And so that also makes a big difference, is that they're not having to answer to a board or to the stockholders or whatnot. And so that makes a really big difference, just because they're very much involved in serving the underserved communities.
First, I just want to thank you for all this information you gave today. It's really encouraged me to pursue this process and potentially buy a home for me and maybe my parents as well. I definitely would love to bless them with that. But I don't know if, amen.
Amen.
Are there any special incentives on the table for a first-time home buyer?
So there's down payment assistance programs. There are a couple of, but you have to go through all of the pros and the cons. Anything, it's not free. So a down payment assistance program is going to be a little bit of a higher interest rate. So just depending if that's really your only option for the down payment, then we'd look to see what the overall long-term cost is, because the interest rate is. But yeah, there's all kinds of programs. There's ways to, if you guys want to get into a home and you have a job, I mean, can't extend financing if you don't have a job or something like that, but there's a way, and it's about being patient and waiting for God's timing and making sure that we're going through the whole process, and that you have somebody that's walking you through the process that cares about it just as much as you do.
Thank you.
One more from Erica, and she wanted me to say thank you for answering her virtual questions.
Hi.
She said, would you ever recommend a 15-year over a 30-year mortgage?
So that's a hard one, and probably Jason won't agree with my answer, but I don't know. We have all these discussions. I think 30. I'm really conservative. I think that with 30-year, you don't have a prepayment penalty. You're able to pay it off whenever you want, and so you can make the 15-year payments without the 15-year commitment. However, a lot of people, if they have the flexibility, won't make that 15-year payment, and then they'll be in debt for 30 years. So it just I just think, you know, I'm very conservative when it comes down to money. I think that it's best for you to pay it and not be committed, but I don't know. What do you think? I think take the 30. The interest rate is better on the 15-year, but you don't know what's going to happen in 7 years or in 10 years. There's all kinds of different things that could happen. And the difference on the 15 and the 30-year, on an average sales price in El Paso is about $600, $400 to $600. So.
What builders does New American Funding work with? And what is the difference between being a preferred lender and, like, I guess if you're building and they're not a preferred lender?
So I'll answer your question backwards. The difference between being a preferred lender and a non-preferred lender is that the builder will pay a portion of your closing costs if you go with their preferred lender. And the only reason that they do that is because they want to have some sort of control of the pipeline, because they're moving houses at 500 units a year, and so it's best to be able to have all of their loans with 2 or 3 preferred lenders versus having them all over the place. And so they'll give you a monetary incentive to keep it with somebody that they know that when they issue the pre-approval that it's solid. As far as the builders that New American Funding is a preferred lender for, we have Carefree, we have Casas de Leon, we have Hakes Brothers, we have a whole list of Sanderson. We just became a preferred lender for Icon. Super excited. Who else? Palo Verde. We have a pretty long list, so I can email you on the side. For the ones that we're not preferred lenders for, because I've been doing this for a long time, I am familiar with a lot of them. And for the most part, we're able to get contributions. If we already have the buyer approved with New American Funding, we're able to get them to give us contributions for the most part.
Well, I would like to know, like, if it would be a process or if it would be something different if, like for me, my parents claimed me on their taxes, but I still filed my own taxes. I have good credit. I have the income, like, for 2 years. And I have all the other documentation, but they claimed me on theirs. Would there be a different process?
It doesn't matter, since we won't ask for we wouldn't know that they claimed you on their taxes, so it doesn't matter.
Tanya. Hey, Tanya, they said your video is ready, so once there's no more questions, if you want to play it, they can play it. Just so you know.
Okay. Any other questions or?
I don't know if I missed it, but on the conventional loan, what would a standard down payment be, percentage-wise?
5%.
And
credit score 620. So you can see the difference between government at 580 to conventional at 620.
would you ever suggest placing a larger down payment?
Yeah, if you have the money, yeah, and if it's gonna wipe you out, then no, because you're tying up your money into equity that's not accessible. And so I think it's much better for you to have it, because I'm so conservative way I think it's better for you to have access to it in case you need it versus putting if it's not required. But if you do have the money, then do 20% down so you don't have to do the mortgage insurance.
Okay, awesome.
Excuse me, I have a question. Hello? What's the average age of the first-time home buyer that has come into your office?
We don't really keep what they qualified. We'll at least try, and if they don't qualify right now, it's not a no permanently, it's just a not right now. So figuring that part out. Edgar, did you want to add anything?
Just to apply. Hello? My only advice is, I ask a lot of people, when are you planning on buying a house? And they tell me, oh, I want to wait a year or two. And I'm like, great, you should apply now. Why? Because that gives you a year or two to figure out what you have to do. If you guys wait a year or two and then apply, guess what? It's another year or two until you get your house, correct? So if you're afraid to do it, and that's why you don't want to do it, because you're afraid to get rejected in a sense, you're never going to own a house. The first step is you have to commit. You have to go ahead and do it. Find out what you have to do to better your situation so you can have your house. I know they asked me about a first-time buyer. I've had an 18-year-old finance a house through me, and I've had a 71-year-old finance a house through me for the first time. So it's never too early, or it's never too late. You just have to be financially stable. You guys have to be smart about your credit. You guys have to make sure that it's the right time. A lot of people want to buy a house because they feel that they have to. That is not true. I don't think everybody should be a homeowner, because some people do it because they feel pressured, not because they want to, okay? The best investment and the best feeling you can have is buying a house. I pay my mortgage and I don't care because it's my house. I know it's my place to be. So my only advice to you guys is don't be afraid. Talk to a professional. Make sure that it's somebody that has your best interest in mind and not somebody who's gonna take advantage of you. Unfortunately, in this industry, there's a lot of people who, are money hungry. They're greedy, unfortunately. So work with somebody who you guys trust, who you guys know that is doing it for, your benefit. I like working with Tania because she, like me, it's gonna sound really dumb, but we don't care about the money. We wanna help people. We wanna help the community, because at the end of the day, what makes my job enjoyable is the fact that I helped you get into your house. I drive by the street and I tell my girlfriend, oh my God, I did a house on that street. Oh my God, I helped that, or I run into people and they remember me, and that is what makes it important to me. So that's what you guys want to look for, somebody who's gonna guide you, someone who you're gonna trust, and like I said, someone who you feel comfortable with. So my advice is apply.
I've been inviting Edgar to come to church for a while, so I'm glad I got him here.
Howdy. Is the microphone on? Yeah. I was gonna say, if I bought a home before, can I still be considered a first-time home buyer?
So you can, as long as you haven't owned a property for the last 3 years. So that is one of the big misconceptions, that they won't qualify for down payment assistance because they've owned a home a long time ago. As long as you haven't owned a home within the last 3 years, then you're considered first-time home buyer. And there's all kinds of different things, when we're looking at the credit. If you co-sign for your sister or your brother or your mom or whoever, we're able to omit some of the payments for the people that you've co-signed for, as long as there's certain requirements. So there's all kinds of different things. Mortgages, I think one of the things that keeps my job really fun, or our job really fun, is that if there's this and there's that, and if there's all these different things, and so it's figuring out how the puzzle's built, how it fits together. And it's so cool when you come in, somebody comes in, they don't qualify, and we're like, oh, I remember this on this other loan, and you go through and it's like researching and figuring out how you can make it happen for them.
Oh, he wanted me to comment on the difference between a 15-year and a 30-year mortgage as far as finances. If you can afford the 15-year, do it, because most people don't have the discipline to do the 30. So that's really the answer. It's cheaper 15 years.
It's way cheaper for 15 years. I agree.
So what other resources would you recommend for someone that's interested in real estate, like authors or anything like that?
I don't have a real estate book per se. I listen to a lot of podcasts. You have my number, text me, I can send you some of the podcasts. There is a book, Mortgages for Dummies, right? Is that the book, no, it's not 101, it's Mortgages for Dummies. I love that book. I go back to it all the time. I think it's super cool because it really just makes the whole process super simple. The book's like $9. That would be a really good one to start with if you wanted to know the process. But get with me after and I'll share some of the podcast.
Okay, thank you.
Charge a pre-penalty fee?
There's no prepayment penalty. There's no application fee. There's no obligation. A consultation's a free, no obligation, no credit report fee. But yeah, no prepayment penalty.
On a mortgage for 30 years?
No.
Okay, so you can pay it off in 15 if you want to.
You can pay it off whenever you want. For those of you guys that own homes, a cool little trick that I think is super cool is if you make bi-weekly payments instead of your monthly payment. So you divide up what your mortgage is by 2, and then you make bi-weekly payments. By doing that, you end up making one extra mortgage payment a year, because there's 26 biweekly weeks, you end up cutting your mortgage by like 6 years. The way a mortgage amortizes, it's like you're paying just interest. For on a 30, you're paying just interest for almost like the first 15 years. And so by doing that, you're accelerating the amortization table and you can pay it off that much faster. So those are all cool little tricks for you to know. Even if you're a homeowner now, that would be a good trick to know.
All right, so you mentioned the VA loans being unlimited now, just recently changing. So how does that apply when you want to purchase, say, a second or a third home?
And still use your VA eligibility?
Yes.
So normally, concurrently?
Yes.
So normally, concurrently, you're only able to use your entitlement with 2 houses, because if you want to do more than 2, there's not enough entitlement to use your VA. And even though they've upped the qualifying amount, or you could still only use it depending on the calculation for subsequent use.
Sales, foreclosures, REOs that y'all keep that y'all keep?
No, thank God. we don't have we don't have any in this area right now. That's not to say like later, but right now we don't have any in our books.
And then another question, a follow on that with the FHA. You said as far as the PMI, that's for the first year because you don't have the equity. You don't have enough equity. So you automatically request for that PMI to be lifted, or does the person have to do that?
So on FHA, the mortgage insurance is there for the life of the loan. On conventional, it's there up until you have 20%, and it automatically goes away after you have 22% equity. But if you keep track of it and you know that you've got 20%, then you can ask the lender to remove it.
So this might be different for everyone, but because you know the length and the process of getting a mortgage, do you recommend like skipping the whole starter home step and just like waiting to buy and saving up more for a down payment for a forever home? Or do you recommend getting a starter home and then when you are ready to upgrade, just?
So this is my personal opinion, and every situation is different. But I don't think that there's anything wrong with a starter home because it allows you to build equity, especially because the appreciation rate here is 4 to 6%. So if you were to keep it, usually starter homes you keep for about 5 to 7 years, and you can have some equity built up, and that way you're not stretching your budget to where it's uncomfortable, because at the end of the day you don't want to be house rich and then you can't go to the movies. And when we do the calculation, we are taking it to the top, and we're not taking into consideration diapers or daycare or eating out or going to the movies or whatever you guys like to do. And so you have to take all those things into consideration yourself and work through a worksheet on how much money are you really spending on a monthly basis. You would be surprised how many people don't even know how much money they're spending on a monthly basis. That's crazy because it's so easy to swipe a card, you know, and so that starter home, I think it's a good idea if it's going to put you in a comfortable position.
Thank you.
Is there a difference when it comes to purchasing a house through a person and through a business? And is there any benefits comparatively
So
speaking?
we only do residential mortgages, and so that is guaranteed by an individual and not a company. Anytime you get an LLC involved or a company, then it becomes a commercial loan, even if it's for residential property, because of the difference of the guarantor.
from your professional opinion, what would your suggestion be in regards to income to expense ratio?
So a comfortable number for that, just off the top of my head, is probably 43 to 45, even though we can stretch it all the way up to 56. You have to take into consideration, is there additional household income? You know, where is it gonna put you? Because really what we're working on is with your gross income. And so we're not even taking into consideration all the money that that you have to pay for taxes. And so if it's taking you up to 56, that's putting you somewhere where you're not able to, like, there's no additional money in the house. So 45 is a good number, 40 to 45, for you to be comfortable.
Question, Mrs. Tania Murray. I've heard a lot you said in reference to mortgages. Knowing that our credit union we're working on getting the credit union started, how can and is it possible that the credit union can partner with New American on deals to help our members and things of that nature? Good question.
Good question. Did you guys do the survey already? Yes, good question. Yes, there used to be, and we put a hold on it last year with COVID and everything that was happening because of what I was talking about with the appetite from the lender on taking additional risk. But we do have a program that's called community lending, and so we partner up with the credit unions or with banks or institutions that don't have a mortgage license, and so we pay that institution a certain percentage, and the loan closes under New American Funding, but it's brokered through the credit union or the bank or whoever doesn't have their delegated licenses. We can play the video, the last video, if you guys have it. Gives you guys a little bit of a feel of our owners and our company and what we stand for.
We attribute our success to New American Funding to really finding the people with the entrepreneurial spirit.
One of the reasons we're successful is because we were a technology company well before we were a mortgage company. That and the fact that we have diverse leadership here at New American Funding.
Our growth, I could attribute directly to the people that understand they're going to grow because of them, which speaks to why our employees have such a strong sense of ownership.
Any company in America that has diversity and inclusion in their corporation is winning.
We understand to be successful, it's because we're cultivating great partnerships with the real estate community. And by surrounding them with the best technology and the best marketing to make them relevant with the millennial wave.
People and the industry sees us as stable and committed. I think what makes us different is the leadership. Rick comes from a marketing and technology background, and I come from a loan origination and operations background. And I think gives us the opportunity to be able to lead this company with two senior leaders.
People who join New American Funding aren't seeking entitlement, they're seeking empowerment.
We have loan officers that came here that then were branch managers, and then were area managers, and then regionals, and now they're senior VPs. So I don't think we're just a mortgage company. I think we're innovators.
We're a technology company. We're a marketing company.
We see this business much more than what it is today, but where is it going?
We're a people company that just happens to do mortgages really, really well. That's New American Funding.
Yay. She's cool, huh? So I appreciate you guys taking your afternoon to come and learn about mortgages. If there's anything at all that I can help with, if I can answer any questions, if I can help you review your credit, we're all here to help. I am really excited about the team that we have on board now. I think Bishop last service said something about us having up to like 60 people under my region, and that number has been cut in half, but our volume was almost double than where we started, and I think it's because we have people that have the right heart, that want to help, that want to help people get into their home, and that are just as passionate as I am and as our owners. So thanks, guys.